What's up, everybody? I just wanted to do a super quick Thursday thoughts because it's been a really, really, really long time since I've done one. Just wanted to do a little bit of market commentary given what is happening at the minute with interest rates. You've seen the Bank of England interest rate go up to 2.25, I believe, today, and the Federal Reserve is 2.75 from memory. Don't quote me on those exact numbers, but all I know is that they are the highest that they've been since 2008. We've had super low interest rates ever since that period in the attempt to stir up and kickstart the economy. At the minute, the economy is flipping running red hot, and so is inflation as well. So we need to tame that beast. At the minute, the market outlook is that there will be a slight shrink in the size of the economy over the next month from in the UK. That is a Bank of England prediction. So that looks like hopefully that is the first sign that things are starting to slow down post the coronavirus pandemic. So given that assets have just been absolutely annihilated the last 6 months, the economy, the stock market has done terribly, crypto has done terribly as well. Bond yields are going up alongside interest rates. Bond yields will always be slightly higher than interest rates, given that there is more risk attached to those. The price of bonds has been going down, I believe, as well, given that people are selling their bonds to put their money in the bank because that is where they can actually get a decent return at the minute, given that the Bank of England interest rate is what I said it was earlier. How cool is that? How interesting is that? Something interesting to observe in the economy. Let's see how things pan out. The idea is that things are going to simmer down a little bit. There's rampant inflation is at least in part related to the amount of money that's been created this last bit. I'm actually pleased to see inflation rates go up. We were talking about negative inflation rates. Sorry, not inflation rates, interest rates. We were talking about negative interest rates not so long ago. That would have been a really weird paradigm shift, meaning that we actually had to pay for the privilege to leave our money in the bank. Also, the how lucrative it would have been to borrow money at that point would have just been flipping nuts. So I'm glad that that's happened. Now we've got a little bit of not just we had head space when it came to interest rates. We had space for them to go up. Now we got a little bit of floor space as well. There's room for them to go down whenever the economy eventually levels off, in case it needs to be stimulated once more. Whereas before, negative interest rates would have been such a crazy, complete and utter paradigm shift. So it's a positive thing, probably in the long run. Where the interest rates ultimately go in the very, very, very long run. I mean, relatively speaking, over if we average interest rates over the last 30, 40 years, I'm going to say that we're still in a period of relative lowness if we go over that time frame. So it's an interesting one, when the governments ultimately pull the trigger on reducing their national debt rather than just constantly and perpetually creating more money, because that in itself, of course, is inflationary. Will they look to increase taxes? Will they look to reduce spending? Will they look to default on their debt? Who knows? The debt bubble is still happening, and therefore there will always be some inflation associated with that. Given that the monetary beast must continue, there must always be more money printing. And interest rates are, of course, used to modulate that. If they go to zero and we still have high inflation, and economies still need a boost, then we need to print more and more money, which is a really not ideal scenario. So let's see how the central banks manage things over the next few months or so. I do think it must be the case that we've seen most of the hikes that there will be to this point. I can't see there being much more hikes. I don't think they're necessary. There's already been enough red. There's already been enough pain in the markets. So just my 2 cents. But then again, having said that, no one thought the Bank of England would raise them as high as they have. So it's an interesting one. It just goes to show no one can really predict the markets. Something to be aware of over the next few months. And certainly the narrative remains the same. If you go long on the correct assets, if you set up correctly from the start and you resist the urge to tinker, eventually your money will always compound, or at least that's what the market has always told us to date, and therefore will always be profitable. So that narrative remains the same. we are of course moving into the realm. We're dwelling in the dimension of making short-term predictions, and we know, of course, that there is a lot of that's not a good thing to do. That's not an advisable thing to do, and it's very rarely accurate. However, it is fun to speculate from time to time, but we just gotta put a little bit of a disclaimer in there too. Guys, thank you so much. That was the latest update on Thirsty Thoughts and Investing. I hope everybody has a smashing week, and I'm looking forward to see everybody again soon.